All right, give me just a second. Got a little bit of audio.
Not sure what's up with the audio. Goodness. All right, how about that? Okay, that ought to do it. Good morning, everybody. Go ahead and get a sound check, make sure what I just did actually worked. All right, thank you. All right, we do got some reasonably decent economic events on the table today, and we do have Bosick speaking today. Apparently, one of the Fed speakers yesterday managed to perhaps get the point across that there is no pivot yet. And of course, the little micro rally that we were seeing was based on the idea that the Fed was likely to pause, and that made bad news good news and good news bad news. On Monday, we had received some pretty bad economic news, and that was seen as a good thing since it could imply the Fed may want to pause and see if their demand destruction and wealth destruction is actually being accomplished. But then we had some good news yesterday, and remember, good news is bad news. And then we also had the Fed speakers trying really hard to reiterate their stance that they are not going to let this ugly beast rear its head again. They want to make sure that it's dead. When we talk about things that are priced into the market, I used to hate that phrase when I was a newer trader because I couldn't understand how anybody would know something was priced into the market. Like, what were you looking at to be able to see such a thing was even happening? And then, like, what did it mean to have something priced into the market? What was how did they do that? How did they put it in there? And it really drove me crazy when I was a newer trader because I didn't understand that concept. And it seemed like that was everybody's default answer for why something didn't happen. Why didn't it move the way we thought it was going to move, up or down? Oh, it was already priced in. Really? I mean, that's your generic answer to everything. It was already priced in. Show me where you see that. And it really drove me crazy. When it comes to the Fed and the market pricing in what they think the Fed is going to do, we can definitively state, yes, it's being priced in. No, it's being unwound. This is by how much, and this is what they're trading to get it wound in or built in or unwound. Right? They're trading these contracts, the QZX, right? So use these tools, right? Because it eliminates a lot of the arbitrary kind of wishy-washy, muddy water situation that's going on in a regular marketplace. You have, proof isn't necessarily the word I'm looking for, but you have cement, concrete evidence to back up your statement. So a 25 basis point rate hike is not on the table anymore. It was at the first of the month, right back in September. They unwound 45% of that, and that needed to go somewhere, right? So right now we're looking at 75 as being the most likely for November 2. It's not November 2 though, right, that we're really focused on, because it seems like everybody's kind of resigned to the idea that we're going to get 75 on November 2. It's the December meeting. Some really smart people have said they don't see a pause until at least December, and that it's possible that we could pivot or pause at the December rate hike. I mean, it's possible. That's a long ways off. Right now, 50 basis points is the leading probability. Because if we get 75 in November, then we will be at 3.75, and to go from 375 to 425, that's 50 points, right? So this is the one that you're going to want to be keeping track of the most. If they start to unwind this 50, or really if they just start winding up more of that 75 to that's going to be a game changer, because this is really elevated. All right, let's get her done, right? It's Wednesday, so crude inventories. A lot of OPEC Plus news coming out in the last few days. White House discussing petroleum's reserve releases. Hurricane that is gone, right? That's done. Give me just a second, guys. I've seen some news come through. All right, no, it's no big deal. All right, so like we want to do every morning, take a look around the world to find out what happened while you were asleep. Get an expectation of what's likely to be on the docket in today's trading schedule. These things can surprise in so many ways, right? And as a trader, you're trying to eliminate surprises. You want to have a really good idea of what's going on around you, and if there's anything scheduled. These are like forced errors that you can just get out of the way, right? It's bad enough, it's hard enough to trade and make money as a fully informed trader. It's even worse when we just run ourselves into a brick wall because we didn't take a look around first, right? It'd be like trying to drive a car with no windshield in it, with just steel there. If you can't see where you're going, you're not going to be able to do it. You can't see what's going on in your trading day. you're liable to run into a wall. I didn't see anything really good on the 5 things you need to know, so we're not going to cover that. But we'll jump over to Thinkorswim, go to Market Watch tab in the upper left. Below that, we go to Calendar. 8:15, 8:30, 9:45, 10, and then 10:30. Normally, the EIA status report would be kind of a little bit of maybe something to pay attention to, catch a trade on USO or something like that. In the current environment, it's a lot more important. So definitely want to be aware of what time it is today as we come into the 10:30 time frame. The PPI, are going to want to listen on this one to see if there's that hint again that the Fed could or should or may pause. Now, when it comes to any of these, when you see, PPI, CPI, just keep in mind nations around the world have the same economic events, and they're called the same thing. So just because you see PMI on there, don't automatically assume it's for America. Kind of just scroll through it real quick. If it's for another nation, it'll usually say something, like the German market, blah, 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 and then you'll know, okay, it's for Germany or Canada or whatever. The time frame will usually tell you if it's US or not. But if they're early morning, it could be us, or it could be Canada, or it could be, say, East Europe. All right, we're looking at a 1-year chart, and we have the weekly expected move here. We expanded way beyond the weekly expected move in the first 2 days of the week. Nearly a 2 sigma move. Now, as we went into the close last week, there was a lot of expectation that we were going to get a little bit of a relief bounce, right? A little bit of short covering rally, kind of monetize those puts a little bit. And then we were just going to roll over and continue this move down. And instead, we had record-setting back-to-back double-digit runs to the upside. That kind of put everything on pause and made everybody step back, kind of try to reevaluate. If it was going to be another run like we had back in March, and then the July-August rally, or if it was going to be more of these shorter duration runs, now we're starting to roll over just a little bit. Some comments from the Fed is kind of helping that out a little bit. We've got more Fed speakers today. And then the econ. The idea is that we close inside the box at the end of the week. So the first thing we want to focus on is getting price back inside the box. It's not necessarily that we want to be bearish and see the market go down. Is we want to see the market actually maintain a consistent normalized move, right? Volatility is high, price tends to move a lot farther. Volatility is a nerd word for movement. So high volatility, if you translate that into normal language, high volatility is big moves. Implied volatility is an expectation or a promise of big moves, right? See how you just get rid of the nerd speak, things start to make more sense. We're in a high volatility environment. We know that it's a high volatility environment because we're making really big moves. We want these big moves to settle down. One of the ways that we gauge such a thing is how far the market moves in a week. It was only supposed to move that far, higher or lower in the entire week. And instead, we basically made the entire move for the week, all of it, in one direction. Almost. Right? Hand grenades and horseshoes. Looking at the 10-week, we're still underneath it, but only by around 3%. We're basically back into the center of the court, meaning that we could move either direction and at a considerable pace and distance, and it would not be considered extreme at this point, right? If we were to go to the weekly chart instead of the daily. So let's go to the daily. All right, we're above the 10 on the daily time frame, not even at 1% yet. And we're pulling back. Obviously, we're going down. We're pulling back towards that 10. Consider the 10 the mean or the average and the starting point, just like at the starting point in a basketball court. It's in the middle. We set our swing high and our swing low based on that white line running from the upper left down to the lower right. That white line is Linreg. There is an indicator for that on Thinkorswim, linear regression. There's a channel, trend line, all kinds of tools. Just type in the word linear or lin reg. And you'll see that Thinkorswim has a variety of these. Be very careful with this indicator. It actually counts how many candles you have. So if you use the indicator on say a yearly chart, daily, and then you decide you want to look at a year-to-date daily, the indicator is going to completely change form because you just chopped off this much candle, right? And every candle matters to how this thing is calculated. So, with a moving average, a daily chart is a daily chart. It doesn't matter if it's 6-month daily, 3-month daily, 5-year daily. The moving average isn't going to give you a different answer. With this, it will. All right, so be very careful. And that usually confuses people, and they say, well, I don't know what time frame to use. It doesn't matter. Use whatever one you want. But whatever one you want, stick with it. Don't analyze it today on a 9-month daily chart and then tomorrow decide, well, I'm going to use a 6-month. It's going to really screw you up. So just pick a time frame and stick with it. The volume is a little light this morning considering, we were plus 200 yesterday and we're sitting at about 160 this morning. Still, it's not really low. That's kind of what we're looking for, a benchmark of, say, less than 100, less than 75. That would really get our attention. Or getting into the extremes, and that would get our attention. And we're at neither one of those, right? So it's fine. It's okay. No worries on that. Which means we don't need this lower indicator anymore and we could turn it off. Get it out of the way, get our real estate back. We do have a retracement line, the 236, sitting at 37.53. That 37.50 area, right? I think we may end up getting a new cog right around in there. Resting on the daily pivot point, it'd be that purple line we see down there at 37.66. We've tested it, managed to dip through it a couple times, but we've not yet closed below it. Still maintaining underneath VWAP. This would be a firm running an algo, when we get below VWAP, they stop, let it buoy back up, activate the program, start selling again. It gets too far from VWAP, they stop, let it buoy back up, activate the program, start selling again. Gets too far away, they stop, right? Filling a client with a guaranteed promise of, well, we'll get you filled near VWAP or at VWAP, right? 20 years ago, that was like, 20 is probably too far away. 10 years ago, that was a pretty impressive promise to be able to give clients such a an in or an out. Now it's whatever. It's nothing. I'd look for that to end, right? When that program is done, you're very likely going to see the market finish buoying in the direction that it continues to struggle with, which is that upside move. So we'll game it out. We are inside day. Start with, we'll give it a couple of zones. We'll start with the Globex that we have. That would be this box here. $37.63 to 3,800. So that gives us a nice zone to work with, right? And inside that zone, you've got your IB, your initial balance, and then the kill zone between 2 and 4, Globex low, Globex high, and Globex open. Now, since it's close enough, what I would recommend is just take your box all the way up to yesterday's highest point. So 38.08, then down to 37.63, and consider all of that one zone. Otherwise, you're going to have this little box at the top with its own zone, and that just doesn't really make any sense. So if all of that is one zone, then the next one would be from our own Globex low down to the cash open of yesterday. Kind of evaluate that box for a minute. It seems a little small, but our only choice at this point, if we don't use just that zone by itself, is to only have 2 zones and take this all the way down to yesterday's Globex low. I'm kind of a fan of that idea. I think I like that better than having 3 zones, but one of them being a really small one. So if we maintain with our own Globex low, or basically that daily pivot point, if we stay there and above, we're going to be looking for topside breakouts, looking for a continuation of this trend off of the lows that started Monday. And possibly even a topside breakout. If we break this pivot point or our own Globex low, then we want to start focusing on hitting all the tree branches on the way down, moving from pivot point to pivot point, from our own Globex low to the previous week's high, the cash open of yesterday, the retracement line that I had mentioned, 236, 38.2, and then 50%, half of the retracement. This is going to be an important level. One, it's the low of yesterday's Globex, right? And it's not spot on perfect, but pretty damn close. Two, it's the IB. I didn't check the time, but I'm pretty sure that's the IB low. And it's also in technical analysis when you're measuring a big candle. 50% is very often that line in the sand on the retrace. We could come all the way back to 50%, and it still wouldn't say that we're going back down yet, right? Like at this point, this slight pullback this morning does not say that the rally is done. So by no means should you go and bear up and try to jump into a bunch of shorts yet. Because if we're still holding above this 50% line, then we're holding above that line in the sand that says we could still make a move to the upside. I've never been a fan of that 50% to determine that a bullish move or even bearish, if we flip all of this around. Never been a fan of that 50%, but technical analysis has been around a lot longer than me, right? So my benchmark is going to be that 236. If we get below that, I'm going to swap to a bearish bias more than likely. The ADR full is at 3,700, basically. And that's still inside of yesterday's price action. So if we maintain our ADR for today to the downside, we should still close within yesterday's price. Now, in these briefings, I've mentioned more than once that there are 3 risk-on sectors: tech, finance, consumer discretionary. And for us to have a good rally, we need at least 2 of those, right? That one could probably do it, but only if it had the help of, say, consumer discretionary, even remotely a little bit of help. And that still means 2, right? If you have one dominant sector and then a little bit of help from another sector. But usually we say things like tech and finance. We need tech and finance to rally. We need tech and finance to do this or that or whatever. What we've had in the last few days is tech versus finance. It's not one and the other combined. It's one or the other. And that's been a real struggle with the market. And then when they do sync, when they are both working in unison, oh boy, we get some real rally, right? Now remember the highly correlated market state we came into the market with yesterday. How I mentioned, we had the opportunity to perhaps activate the alpha protocol. The high correlation coefficient means we had tech and finance working together. But if you notice here on the chart, finance kept what it had and actually closed into the highs, while technology faded off and almost took out the 50% line on that really big candle. And I just talked about the 50% line on really big candles. And it did manage to rally up off of that, but it certainly didn't close at its highs. And, it looked like a saver down there, right? So we lost finance, or we lost tech yesterday about midday, and it caught and held, got saved, but it just about all fell apart yesterday. And I would continue to watch that this morning. Keep your eye on technology. This is the FANGs, so what I call the monsters of tech. Apple, Amazon, Tesla, Microsoft. But this is an ETF that also has Twitter in it. And Twitter news came out yesterday, which buoyed Tesla and Twitter, because Musk came out and restated that he would pay the original price that he had first offered for Twitter. Volumes, or cumulative volumes, went strong into the close, and the AD was pegged out. So when we closed yesterday, there was solid breadth, positive breadth, and a nice little save within the monsters of tech. Now this morning, Twitter's down, Tesla's down, and as we're going to notice when we go digging around, probably most things are down, right? We're in a correlated market this morning to the downside. I want to point out that the green line yesterday, once everything stabilized, like finance, and we never really, continued that rally, but we did close near the highs, and tech got saved. We kind of made that little run up The green line did not get back inside the middle of the channel where it should be, and it certainly wasn't leading to the upside, showing that we were going to get some late afternoon rally. And it stopped falling and was holding the line, not leading us lower like it was right in that area here. Right, that breakaway. The green line is a beautiful heads up. When that sucker breaks away from the group and starts running, you will very often get a change in market sentiment. Then when everything stabilizes, if it's just going to maintain its range for the rest of the day like finance did yesterday, what we typically would see is the green line riding in the middle of the channel. And it wasn't. So if you get used to this indicator, it's really useful. I know it seems kind of generic and blank, but simple works. Simple works really well. I've been using this indicator for over 2 years now. I look at it every single day. And the more you use something, you learn its quirks and its style, the better you become at using it. This simple, generic little tool is an amazing heads up that continues to make me a lot of money. So it's worth evaluating when it gives odd signals or gives really clear, beautiful textbook signals. Capture them, take pictures of them, study them, so you learn to recognize when you're getting a money-making signal. All right, the volume profile, 10-day, 30-minute. TPO on the right, volume profile on the left. We managed to get above the point of control, expand all the way up to the next level, which is very likely going to be the new point of control if we can't resolve this and we happen to stay here for a week. But it is that 3780 area that we've talked about on Monday and Tuesday, that if we were able to get through all of the trash from around this point of control, we would have a nice shallow area to work through, what I often hear called an air pocket of risk. So we made it through that air pocket. Now we're into another resistance zone. It's volume resistance from volume nodes, N-O-D-E. We didn't manage to get through it. So, or close above it, I guess is a better way to say it. We didn't close above it and faded back through it. So now we've got a bit of a fight on our hands if we're going to make this move to the upside. Now, economic events can push us right through the trash really fast. So that 3,800 area, we'll use that for our benchmark. This morning, if econ comes out and we happen to break through our own Globex high and get above that 3,800, we've got a very shallow area and should be able to get to 39 relatively easy. I hate using the word easy in trading. There's nothing here. Right? And that means we can move through that really fast. Now, speaking of nothing there, underneath us, there's still not very much there. So if we happen to break our own Globex low, we could very easily see 3,700 again. Very easy. Right? So that's something to keep in mind as well. We do have an untouched point of control from yesterday, so a VPOC or a virgin point of control. That is absolutely worth carrying forward into today's session. That's SPY. We got to change the chart here. Aha, that looks better. On this, we do not. So SPY has an untouched point of control, something to consider. But on the ES, we do not have an untouched point of control. We do have one underneath us, but hopefully we won't go that far today and test it, right? 3667-ish. I didn't get it spot on perfect, but it's down there. I'd call it 3670 just for some, something easy to remember. was making a new grid yesterday. Somebody had reached out and said they don't have futures, and of course, if you don't have futures, you can use kind of an ETF equivalent, right? It's not going to be exactly the same grid, but it'll get the job done. And when I did that, I ended up, of course, losing my own grid. But that's okay because we got grids. That's why we want to save our work, right? Always save your work. You never know when Thinkorswim is going to delete one of your charts, or when you yourself will accidentally screw up a chart that you really wanted to keep. So save them. The Bank of Japan has yet again managed to defend that 145 zone. Of course, it did help that across the board, everything kind of shifted in the last few days. But I would look for this to retest that 145 again. Almost got back to parity in the euro dollar. We are inside day breakout in the 30-year. Kind of be watching this today. Looking to see if that gets a lot more weak. Now, I mentioned the other day that with the dollar acting the way that it is, we need to look a little more closely at volatility. So here's the 1 month, 29.45, the 3 month, 29.67, and then 30.60. So we had slipped into backwardation, and now we're back out of that. Things are normalized. They're back into the normal curve again. The 9-day is higher than the 1 month, but that's okay. The 9-day is really, really close. It's the front end, and it very often will exceed the 1 month frequently. I know that there are volatility traders out there who can take advantage of this, but it's not really my jam. So, I keep my eye on the 9 just to see if it makes some explosive move, right? But other than that, I don't really pay attention to what number it is, and I certainly don't put it into the contango curve. We're back above 29, and that's a little bit concerning. I'd keep my eye on the 30 level on the VIX. If we get above 30, I would be concerned that the ES and the NASDAQ, basically the equity markets, are going to break lower and start to go back down again. Right, so we want to see the VIX stabilize, stay below the 30. If you want to give it a little bit of playing room, you could call it 30 and a half. Right, so as long as we stay below 30.5, then the S&P and the rest of the market should be able to hold the lows of today or the lows of yesterday without really breaking down and getting significantly bearish. If we happen to break below 28.5, I think we're going to see another rally like, at least the March one, right? The March one was like really fast, nonstop. Not a stair-stepping pattern either. It was, at least if you look at like Apple's March rally, that damn thing was like 9 days in a row of green. So 28.5, maybe 28 would be like crazy bullish, and above 30.5 would be, getting into some nasty bearish. Otherwise, if we just chop around, kind of expect the same thing in the rest of the market, that kind of a chopping around a little bit. Russell volatility is basically doing what everything else is, and so is the NASDAQ. So they're just sideways and kind of chopping around. It's fine. All right, the triples are in control this morning. We get past those, got gold, and nat gas, uranium, surprisingly Bitcoin. So all of those are down this morning. My benchmark is 0.5%, and that is way down here. So all of these names are down at least 0.5%. And it's a lot of the commodities, energies, chemicals, but I'm also seeing, materials, financials, consumer discretionary. Remember, those are our risk-on sectors. Now, things that are positive this morning, there's basically nothing more than the dollar and the VIX. Looks like we got a little bit of a squeeze on the 1 hour in natural gas, and it's about it. Materials has got a sizzle this morning. Maybe that could be a carryover from yesterday. Yeah, that was just yesterday's carryover. So when you get a volume like this, it's a really high volume level. It triggered volume sizzle. One of the things you want to do is go in and look at the options for that product and see what the options were doing yesterday. Because if you're identifying a gamma squeeze, some of that comes from the options, but the other side of that comes from the shares. The idea behind it is kind of the Reddit GameStop situation. Reddit GameStop crowd attacked all the short interest, high short interest products out there and forced the market makers to buy shares, which squeezed the heck out of all those shorts. How do they force the market makers to buy shares? The market makers want to get to delta neutral. Shares have a hard delta. So if we buy an option, whether it's a call or a put, but if we buy an option, even if it's really far out, and we buy them pennies cheap, the market maker needs to hedge that risk. If they're carrying shares, they can hedge that risk. They can get back to delta neutral. So if a bunch of options are getting bought up, it forces the market maker to go out and buy a bunch of stock. So you don't want to just see high options volume. you want to also see high share volume, because it is a bit of the checklist for, is this a gamma squeeze? Stock sizzle is what Thinkorswim uses for shares, right? So I don't know why they don't just call it, shares, or I don't know, stock sizzle. So that's share volume. It's not as high as I would have wanted it to see. And then the sizzle index. So not a gamma squeeze here. It did get some activity that's of note, but not enough. And then the bulk of the trading was done just outside of the money on the call side. And on the put side, it was a lot farther out of the money. That's a big number. Is the October and November nah, they've already reset volume. All right, we do have a market maker move this morning on XLB2, or also. I got a paper coming out, or a video. I guess I'm going to turn it into a video on trading gaps. Not necessarily for day traders, but for technical analysis and swing trading. I think I might use this. I was going to use Tesla, but XLB might be a good one to use. Anyways, let's go. All right, 57% of the S&P this morning is down more than 0.5%. Again, like we normally do, want to get an idea of what's not on that list yet. And does that mean that that particular sector or those names in that industry are doing good this morning? And is it a sector or an industry that is powerful enough to turn our market around and actually give it some structure and forward guidance? %45% of the NASDAQ is down at least 0.5% this morning. Both of those numbers are a little bearish, but not that bad. Right? It's not as bad as I had expected. Here we've got the heat map, S&P 500. We want to set this to pre-market. Use a filter to try to get it down close to around 100 names, which is not always an easy thing to do. 89 will have to do. Change the multiplier for how soon color is applied to the box, And the size of the box gives you an idea of the market cap. And it's an easy way to see where the monsters of tech are at, right? They're the big boxes. So Microsoft, Apple, Google. The monsters changed names, right? Remember it was Fang, and then it was Fang Man, and it was Fang Man plus T, and now David Keller just calls them the phenomena. It's just a bunch of blah, blah, blah. I just stick with monsters of tech. But they'll shift. So when you're looking at the big grid, when you start to see something really gain in market cap and its box is getting comparable to, say, Meta or Nvidia, and it is a technology name, then you consider adding that to your homemade little monsters of tech list. I just use the ETF for now on. So the NY Fang, I use that. That way I'm not the one choosing what's in it and what's not in it. Walmart's up this morning, which is kind of interesting. Nothing else in its peer group is up, but definitely take a look at Walmart and see what's going on. I'm sure there's some news with it. Amazon had news this morning about a hiring freeze on high-ranking Amazon employees. There's no hiring freeze on the warehouses or delivery or the worker group. Just the higher-ranking office is getting a hiring freeze. It certainly seems like financials are doing worse than technology this morning. Again, continue to keep your eye on that. We want to see tech and finance, not tech versus finance. All right, 27% of the S&P is down more than 1% this morning. Some of the biggest names in that downward move is Lowe's, General Motors, General Electric. Caterpillar, I mean, it's kind of a mix, right? It's got all kinds of stuff in here, but those financials are popping up in Morgan Stanley, Goldman Sachs, JP Morgan. Then you've got the trend reversal plays, Nike, Boeing, Disney. There are not very many companies that still look as good and as healthy as Apple does. The short target is still 130, and it is the make or break line for the rest of the market. So Apple below 130, we're going to be looking for the S&P, to get below the pre-COVID drop, so that January 2020. Call it 3,400. If we see Apple break that 130, then S&P below 34. And that would be my target, right? Now I was looking for a new place to sell some calls on the ES or the MES. It's been a nice swing trade. For day trades or for end of week stuff, not a big deal, but for a new kind of a bigger position, I already closed my 44s. I'd like to open some 42s and get a little frisky and maybe open some 4,000s. So if we can get this rollover to break below, say, 37, yeah, let's make it 37. If we can get back below 37, maybe selling some 4,000s, 4,100 if you're a little nervous, and that would be a nice move into through October, right? I'd probably get out before the November 2 Fed meeting. So I got everybody, be careful, be safe. I will see you all tomorrow.